Hey everyone, welcome back to Invest with Alex, where we break down investing and finance in a simple, easy-to-understand way. If you're new here, make sure to hit that subscribe button and turn on notifications so you never miss an episode. Today, we're diving into one of the most powerful forces in wealth building, compound interest. Albert Einstein supposedly called it the eighth wonder of the world. But what is it and why is it so important for growing your money? By the end of this episode, you'll understand how compound interest works and how you can use it to your advantage to build serious wealth over time. Let's get started. So, what exactly is compound interest? In simple terms, compound interest is earning interest on your interest. Instead of just earning interest on your initial investment, your money keeps growing because previous interest payments get reinvested and start earning more interest over time. Here's a basic example. Imagine you invest $1,000 at a 10% annual interest rate. In year one, you earn $100 in interest, bringing your total to $1,100. In year two, instead of earning interest just on your original $1,000, you now earn 10% on $1,100, which is $110. This continues every year, and over time, your money grows exponentially. This is why compound interest is so powerful. It turns small investments into massive wealth if you give it enough time. Let's compare simple interest versus compound interest so you can see the difference. Simple interest, you only earn interest on the original principal amount. If you invest $1,000 at 10% simple interest, after 10 years, you have $2,000, $1,000 original plus $1,000 in interest. Compound interest. Interest gets reinvested. With 10% compound interest, after 10 years, you wouldn't have just $2,000, you'd have $2,594. And the longer you leave it, the bigger the gap becomes. So, if you're serious about building wealth, compound interest is your best friend. Now, let's talk about the rule of 72, a quick way to estimate how long it takes for your money to double with compound interest. The formula is simple. 72 divided by interest rate equals years to double. For example, at a 10% interest rate, your money doubles in 7.2 years. 72 divided by 10 is equal to 7.2. At 6%, it takes 12 years. At 3%, it takes 24 years. This is why higher returns make such a huge difference. Even a small increase in interest rate can shave off years in wealth accumulation. So, how can you take advantage of compound interest? Here are 3 powerful ways. Start investing early. The earlier you invest, the more time your money has to grow. Even small investments made early on can turn into huge amounts. Reinvest your earnings, whether it's dividends from stocks or interest from a savings account. Let your earnings compound instead of cashing them out. Consistently add money. Regularly adding to your investments accelerates growth. This is called dollar cost averaging, and it's a great way to build wealth over time. Let's look at an example. If you invest $100 per month starting at age 20 at an 8% annual return, by age 60, you'd have over $350,000. If you start at age 30, you'd have about $150,000. If you wait until age 40, you'd have just $65,000. The lesson? Time is the most important factor. Even though compound interest is a powerful tool, many people make mistakes that slow down their wealth building. Here are a few to watch out for. Starting too late. The later you start, the less time your money has to grow. Not investing enough. Just saving money in a low-interest bank account won't help much. Investing in assets like stocks and index funds gives much higher returns. Pulling out money too soon. Withdrawing your money early kills the power of compounding. Avoid these mistakes and you'll be on the fast track to financial success. You're probably wondering, where can I invest to take full advantage of compound interest? Here are some great options. Stock market, ETFs, and index funds. The S&P 500 has averaged 8 to 10% returns per year. Perfect for long-term compounding. Retirement accounts, 401k, IRA, Roth IRA. These accounts allow your investments to grow tax-free or tax-deferred, maximizing compounding power. High-yield savings accounts, good for short-term savings but don't expect high returns like in stocks. Real estate, rental properties generate rental income, which can be reinvested to buy more properties. Choosing the right investment depends on your financial goals and risk tolerance. Alright, let's wrap this up. Key takeaways. Compound interest is earning interest on your interest. The longer you invest, the more your money grows. Even small investments add up over time. Use the rule of 72 to estimate how fast your money doubles. Invest in stocks, retirement accounts, and real estate to maximize compounding. If you haven't started investing, start today, even if it's just $10. Set up an automated investment plan to regularly add money. Stay consistent and let time do the work for you. If you found this episode helpful, hit that like button, subscribe, and leave a comment. What's your biggest takeaway from today's episode? In our next episode, we'll be covering how to build a diversified investment portfolio, so stay tuned. See you next time.